There's always something on the horizon. This could happen, that could happen. And that's what I try and do is I try and anticipate what challenges could lie ahead with us. The biggest one right now is real estate values. The pressure on housing affordability with the increase in interest rates. We're keeping it very...
Welcome to The Flow, Real Estate and Money Show. For people in Canada looking to understand the home buying process, to demystify real estate investing, and to make mortgage financing accessible for anyone. The goal here on this show is to help people understand ways to make their money work for them, get in the market sooner, and realistically, completely open up the box on how mortgage financing works. I'm Alex McFadden, your host, and I can't wait to help get you into the flow. Private lending is scary. Private lending is bad. It's something that a lot of people talk about on the news, and you're going to lose a lot of money. Well, that's what they say, at least. But it's not actually the case. And the intention of today's conversation is to share with you a little snippet about how private lending actually works. And one of the people behind a local mortgage investment corporation out of the Vancouver area in BC, so that you can find out a little bit more about how he thinks and what his evolution was and where the money is going and what's actually happening. That's the goal here, is to really understand the specifics of private money, how it works, and see if it makes sense for you as an investor to get involved with. Brad Currie joins us today. He is one of the owners and one of the directors of Financial. And last year, he lent over 75 mortgages out over to many different families and had the experience and the opportunity to see what's been changing in our real estate landscape firsthand, understanding specifics of where people are investing their money, where they're losing their money, and what's actually happening. I couldn't think of a better person to come on than Brad to actually talk a little bit about what he's experienced lately, but more importantly, his relationship with money and how he got involved with private lending and what he would do if he had money to invest today. It's a smoking episode, and there's just so much to take away from the conversation today with Brad. I hope if there's anything that you take away from this conversation, it's just an understanding that there are different options out there, and what you read on the news isn't always right. Enjoy. Just like that. Love to hear it. Brad, what's up, man? How are you doing?
I'm doing great.
Excellent.
Thanks for having me here.
Yeah, of course, man. I like the moment we come in. How are you doing? I'm doing great. I'm doing fantastic. I love the energy. On a Sunday morning, I asked you to come down to 11:30, so thank you for doing that. Appreciate it.
Oh, you're welcome.
Before we're talking about the depths of private lending and mortgage investment corporations, I understand you're heading over to Hawaii in a week's time.
Yeah, over to Maui.
Oh, man.
So I'll be there for a week in a golf tournament with about 140, 50 people. So
love it. So finally able to let the steam out after this. How long does it take you to build out these annual reports you're working on right now?
Oh, it takes a good 4 or 5 days, a few hours at a time.
Yeah.
On
top of day-to-day work.
On top of the day-to-day things.
Nonstop. Yeah. An annual report, just so our listeners know what we're talking about here, what does that actually entail? What is the purpose of it? What is it?
Well, basically, it's to report to basically former investors. Report to investors once a year. So we've finished our year end. Our financials have been all audited now. So we prepare a report that we give to all of our investors, which also is part and parcel of doing an online PowerPoint presentation for them as well, coming up here on Thursday.
Right. And when you're talking about investors, you're talking about the folks that are putting the money, giving you the money to go in and lend out, right?
That's right. The investors
Perfect.
about shares in our company.
Well, we kind of fast forwarded a little bit, didn't we?
Yeah, we did.
Yeah, we jumped right into it. Yeah. But that's okay. Most people have a general understanding of the idea or the concept of a private money lender. But right. I would argue that most people's general understanding is exceptionally vague unless you're in the industry. And then even being in the industry, it can be convoluted or complicated because it's a MIC, or is it a single person, or what the heck? What are all these different things? So, Brad, if you were talking to a grade 5 individual, and you were to explain to them what is a private lender, how would you explain that?
To a grade 5 individual, basically, a private lender is somebody who has money that they want to lend to somebody else in return on their investment.
So an exchange of interest.
Exchange of interest, exactly. Perfect. They want to borrow some money and they want to pay it back with some interest on it.
Okay. So now there's different types of private lenders.
Correct.
Right?
Yeah, that's right.
And can you help us understand what the different types could be?
Yeah, for sure. There's, in terms of the private lending space, there's mainly two. We have the mortgage investment corporations, and then you have individual private lenders. So an individual private lender would be somebody who says they have $100,000, for example, and they want to lend that money out in the form of a mortgage to another individual. So they would lend that money out, negotiate the terms, the rates, etc., and receive the payments directly. Okay, so a mortgage investment corporation is more like a pool. The best analogy is a mutual fund. So you buy a share in the fund, in our case, a stock, a share in the stock of the company, and all the money is pooled and lent out over a number of different mortgages. So it basically diversifies and spreads the risk around. So all your money's not lent on one particular loan, because if that loan were to go bad for some reason, the individual accept all the risk.
Yeah. Okay. Fair enough. And that's in the individual case, of course.
Yeah.
Whereas the MIC, as you mentioned, you all share the risk together, so there's less risk.
That's right.
Associated with that.
Yeah.
How do you even get involved in private lending, Brad? I want to know. Let's go back to your specific situation. Where did private lending in the journey of journeys come in? Where did that come into play?
Well, I was in the mortgage industry. I started way back as in real estate, but before about early 1990s. And then I eventually became an independent mortgage broker around 2001. And that's when I started to get exposed to lots of different lending opportunities and started to work with private lenders for clients. And I found that I started reading up on it, learning about it, and I thought, well, this looks like an interesting business opportunity. So we started in 2008, opened up a MIC in 2008 as a part-time thing to accelerate along with what I was doing as a mortgage broker, and it just evolved over time.
Okay. So just like a natural evolution.
Yeah.
So you went from real estate into mortgage and then into private lending, and then you're like, hey, I like this MIC thing. Let's go.
Yeah.
Let's give it a shot.
We give it a shot. And we started out, and I think we started out with $200,000.
Yeah.
To lend out, and that went pretty quick.
Yeah.
And then now we've built it up to the point where we're just almost 19 million.
Wow.
Size.
Incredible.
Yeah, in terms of total assets.
Pretty substantial growth.
Cash
and that's been in what you said about 13, no, I guess
15 years. 15 years, yeah. So it was interesting because we started in 2008, we started in April 2008, and of course September 2008 was when the financial crisis occurred, right?
Lovely.
So it was interesting times, right?
So what was it like to go through that?
Well, it's always an uncertainty, right? You always get into new ground, but at the end of the day, there's a need out there to fill. People need money, and we make some lending decisions and try and be as prudent as we can, and continue to go through it.
So, thinking about 2008, and then now forecasting to where we are today and looking forward, not exactly the same, but there's obviously a lot of calls for some level of recessionary measures and concerns of people losing their jobs and inflation. Does this make you think back to that time and what it was like back then at all? Any memories?
Well, it's interesting because, I'm putting together this report and a lot of it's data, but a lot of it, is commentary as well. And it's kind of reflecting back over the last 15 years. And there always seems to be some challenge that we're facing, right? It's never sort of smooth sailing. There's always something on the horizon. This could happen, that could happen. And that's what I try and do is I try and anticipate, right? What challenges could lie ahead with us. And the biggest one right now is real estate values. Right? The pressure on housing affordability with the increasing interest rates. We're keeping a very close eye on real estate values, not only what they are today, but where they could be.
Right.
In 6 months or a year from now.
And as a private lender, when you see property values going up, it provides probably to a degree a level of comfort. Well,
put it this way, increasing real estate values makes up for a lot of bad lending decisions.
Right. So you get chance 1, chance 2, chance 3. So when we see the NDP and the federal government coming in and providing regulation after regulation, trying to dip housing values and create a little bit of indigestion, a little stress.
Yeah. Yeah, definitely. Yeah. I mean, and I'd like to see it starting to turn the corner a little bit, like maybe looking at ways of, rather than penalizing certain participants in the market, there's starting to talk, there's some more talk about incentivizing.
Yeah.
And this was something interesting that when I started my career back in the early 1980s, they used to have a program called the MERB program. And what it was designed to do was create more rental housing. units. And what they did is they had, it was multiple unit residential building. That's the acronym for MERB. So what they did is they created the ability for an individual investor to buy a unit in a building, which is going to be rented, and they were able to depreciate that unit, claim depreciation on it from a tax perspective. So it created actually an artificial loss in their cash flow, right? So that loss on that unit could then be written off against their other income. So it created an incentive for a lot of professionals, people to purchase these investment units. And of course, a lot of units were built.
Why do you think it is that, like, we'll walk down that road right now. Why do you think it is that at that time they were so pro real estate from an investment perspective? In the United States, of course, they allow the depreciation write-off still.
Right. And
in Canada, we've gone almost 180 degrees the opposite direction.
That's right.
Anti-investors, anti-investment properties, anti-everything to do with investment real estate.
Right.
What are your thoughts on why we've gone that far in that direction?
I think it's that, sometimes the government feels that they're the ones who have to do everything, control everything. But I think they're maybe starting to realize they just can't do it. It's too big a task. You need the cooperation of private enterprise and to make things happen.
Right.
So rather than penalize, I think it's a better approach to incentivize.
Right.
Right.
What a concept, eh?
Well, yeah, and then you can see that now the federal government is trying to incentivize municipalities or cities to fast track new projects.
Yeah, right? If only they were on the same page.
If only they're on the same page, but at least they're starting somewhere.
Yeah, it's a good sign. It's a good start. We'll see where it goes from there. Brad, I'd love to know about your personal journey around money. I guess it's been 12 years now of being involved in the mortgage industry and working with countless professionals, countless people in the industry, out of the industry, real estate and otherwise.
Right.
I've learned that money is a deeply emotional topic for a lot of people. And a lot of times their past can dictate how they feel about money today, and it can dictate the success that they have financially in the future. When you grew up, how did you first understand the concept of just how money worked, and where was your first foray into understanding the idea of investing versus saving, and where did you learn these things?
Well, going back, I think my parents were very, very helpful in the beginning. I mean, growing up, I think we did okay financially as a household, but we didn't spend a lot extra on things, right? So everything was, before any expenditure is made, thought was given. Right? Do we need this? So do we don't need it? That sort of thing. And then also starting out early in my career, didn't have money. It was tough. I started selling real estate in 1981, which was actually the peak of the last real estate boom, where the interest rates shot up in the month of March, I recall. We started heading up and eventually got up to around 19-20%. And real estate values are dropping. I couldn't make a living. I had to leave the industry, and then came back a few years later. So when you don't have money, when you start to earn some money, you start to appreciate it more, right? What it does for you. And so one of the concepts of my education, my economics teacher, I recall, is very simple concept, is that when you earn $1, you have a choice. You can either spend it or you can save it, right? So that was sort of the whole concept of starting saving. And then when I was fortunate, my wife is very smart with money too. So when we got married and everything like that, we started to really focus on money and saving, etc. Do we know exactly what to do with it and where to invest it? Those sort of things. No, those things have been learned over time, but.
So thinking back now from that time, as your parents taught you obviously about the worth of $1, so did The Economist, and your wife understood it. You mentioned saving a few times, but we haven't really talked on the idea or concept of investing, which obviously you're heavily tied into at this time right now. Right. Time goes on. What were some of the moments, or if you could think of any moments in your life that really got you understanding and building up the concept of investing? Like, what was it that triggered you, and how did you start to figure this out?
Well, as a process over time, I found. So I remember we used to contribute to RSPs a lot, right? Yep. That was any savings we had, we put in there. We had, because you get the tax deduction, et cetera. And then you start to accumulate some money there, and you go, okay, what's the best way, how the best way to invest it? So at that time, I started dabbling and buying some mutual funds and a few things like that myself. And then, you start to get a little bit more money, and I thought, okay, I looked at the world of financial planners. So I said, well, at the time. Say if I'm generating 8% a year myself, I would think a financial planner with their expertise should be able to generate more, right? X plus something. So went down that route. And then found that sometimes you're dealing with one planner and then they leave and they go to a different firm. And, there's a lot of change there. And then a number of years ago, I met a fellow by the name of Dougal Shewan. I don't know if you know Dougal or not, but he was a founder of VWR Capital, okay, which
Private lender,
another private lender, major private lender, a competitor now. Anyway, so I got to know Dougal, and we did some business and together. And he said something to me that really stuck in my mind. He says, do something with your money. That don't invest in things don't invest things you don't know about. Right, and that stuck in me, and that's when I started thinking, look at different ways, investing in some real estate or investing in mortgages, these sort of things. So I try and key on my own personal preference. I think diversification is very important, but I try and key on invest in things that I know about. I don't know anything about Bitcoin. At Bitcoin, obviously, people have done very, very well. Some haven't, but have you? But I don't understand it, so I'm not going to invest in it.
So key. Invest in what you know. I think just the willingness to take the step forward and actually start investing and start learning about it is a key point that you had mentioned there.
Right.
For most people that I talk to, the challenge associated with money is the fear of investing in general. And I think that comes down often to a lack of knowledge, which is what we're trying to accomplish by having these conversations here today and providing opportunity for people.
Right.
Was there a point at which you made an investment mistake at all? Was there anything that happened that caused you to lose money? Or
Sure. I mean, I think I'm guilty of, you're talking with a buddy or what have you, and they tell you, they've heard about this stock. It's, the XYZ company is going to do this or that, and you end up buying it, and it goes the opposite direction. So I've made lots of those mistakes over the years.
Yeah.
Looking for the big win.
Right. The quick win.
The big, exactly. So definitely, that was definitely something that I recall getting sidetracked on.
Sure. If it looks too good to be true, right?
That's right.
Okay. So how did you transition from saving to investing?
Well, I think saving, before you can really start to, as soon as you start saving, you can be investing, right? It's just as you start to be able to accumulate some more savings, then more options open up.
Well, I truly believe that. So many people, they don't think about the concept of even investing their money, and certainly don't think of anything outside of whatever their bank offers because of a fear of losing the savings and a lack of understanding of what investing is and what it isn't. And so for most people, even the average Canadian that is saving money, their concept of being able to invest is, I don't think I can do that right now. I don't even understand it. And I don't know how to bridge that gap. So I always find that there's a point often with people where it goes from, okay, now I understand how money works and it's dollar in, dollar out, or however that money goes out. But how did I make that transition to actually having money that I've saved to now thinking about what can I do with my money? And that's powerful.
That's right.
Because while you might not think about that, I think a lot of people don't actually consider the power of what their money can do for them if they just take that next little step. Right.
And that's definitely true. I look at it like, it's very challenging today, though, I think, for people to save money, right? It's under these circumstances that we've been in for a number of years, really.
No doubt.
We just see that as how many first-time home buyers have you worked with, in your career, who've actually saved every dollar that they're putting as their down payment, even being 5% of the purchase price, right? So there's always that sort of assistance. So it's definitely a challenge, but it can be done, and people do it. The other thing, too, as I look at is, people purchasing a property, I think, is such a fundamental pillar in their overall financial plan, because that's saving money, right? Because, you make a mortgage payment every month, majority of it's interest, but the other part's principal, and that builds up equity in that house, that property, and that's savings that can be used for future, right?
It's so true. It's so true. Well, yeah, thanks for sharing your insights on the investing side. So one of the actual investments that people consider, and in particular when they're asking us, we're not financial planners, but if they ask the question,
that's right.
One of the opportunities is investing into private lending. And in many circumstances, that might be a situation where someone isn't able to, or prepared, or wanting to invest into real estate as far as just a house. So one of the options is a mortgage investment corporation. And the thing, I think the reason that a lot of people don't is because, again, a lack of understanding or fear. Oh, I thought those were only, high interest loans for people who, don't have a job or don't have any opportunities. And, oh, don't they foreclose all the time? And, is this some guy that's hiding in a closet? I mean, you might work out of your closet, but so these are the types of things that we hear all the time from our borrowers and people who just generally speaking ask what other opportunities that would be out there. So from a mortgage investment corporation point of view, what do you think is I guess in your mind, what type of person are you looking for as an investor? Do you try to qualify people based on their level of experience, or what are you looking for when you're looking for an investor?
Well, unfortunately, we just can't take out every investor, given the regulations we have to operate under. So when we started out, and a lot of mortgage investment corporations start out this way or operate this way, and it's just basically investors could only be our immediate, like family, friends, and business associates. Once we get beyond that, then the BC Securities, who regulate mortgage investment corporations in British Columbia, want investors to meet certain criteria, which is what we call accredited investors, which is one person with $1 million in net assets, not including real estate.
Wow.
Or a household person who's earned $200,000, or a household that's earned $300,000 per year gross income. So it really limits down the people who can actually participate.
So that sounds like could be very prohibitive relative to 10 years ago.
Yeah, and it's really unfortunate because mortgage investment corporations have proven to be very solid investments. Right now, there's been bad stories, like there are in all investment scenarios, but perfect. I'll use an example of somebody who came to us. It was a retired gentleman. He had $100,000 he wanted to invest, but he was retired on pension and couldn't meet the criteria. But here he is on pension, looking for a way to protect his money, wants a good return, better than he can get in the bank, and doesn't want to take the risk of investing in stock markets or mutual funds, which can go down in value, right? Most mortgage investment corporations, like in the 15 years we've been involved, we've never lost money. We always make money. It's just the nature of the business, So but the regulators feel that this is a very risky proposition, even though they've been around for a long time. Mortgage investment corporations started back in, I believe it was 1984, early 80s. So they've been around for a long time. So there's a lot of number of them out there have good track records, much longer than ours. So, but it fills the gap between that, term deposit, GICs, versus, investing in mutual funds, which can experience, or stocks directly, which have more volatility, have a better return potentially, but more volatility.
So why do you think that mortgage investment corporations or funds have been pigeonholed like this?
I just think there's just been some bad situations where people there's some bad apples, right? That have caused the regulators to don't look as favorably on what mortgage investment corporations are doing.
Interesting. So I'm just looking at your upcoming annual or financial report here, annual report for 2023. Thanks again for sending that over to us. And having a little peek at the annual return or expected return since 2009. And looking at the report, the lowest I can find here is 7.66%. It's annualized, I assume. Yeah. 7.66% annualized. And for, I would say, probably obvious reasons, and the interest rates in 2021 were incredibly low.
That's right.
During that year. But other than that, we've had high watermarks of 9.69 in 2015. And for the year 2023, it looks like we're at 8.35%. And I would imagine it's likely to grow with interest rates increasing for 2024. That's right. As well for the next year. That's pretty incredible when you think that for most people, yes, you can get a GIC paying 5% right now or 4%, but typically speaking, that's not the case. And usually most people have their money in some kind of a fund paying 2 to 4% interest or something of that nature, correct? So again, looking at that from that perspective, would you say that this has a lot to do with your fund? Like you as a private lender are just very focused and clear and able to return these funds? Or is this something relatively typical from a private lender in Canada?
It's typical.
It is typical.
It's definitely typical. Yep.
Okay. So it is pretty typical. I love this as well. $25,000 invested in 2008. You provided a really good chart. And these numbers are so key. And I appreciate that you shared these with us, because a listener really should understand, what does it mean to invest? Like, it's one thing to say 8%. What does that mean? Right? It's like an interest rate of 2% or 4%. Well, what is my payment? Right. So specifically $25,000 in the TSX from 2008 would have been worth $37,000. For reference, the Dow 76. So obviously a fair investment fund. Yourself, $80,000, 198 based on, and that's after expenses as well.
That's the investor's hands. That's right.
Right. So the actual fund is doubled what you say is every 6.3 years. Now, while maybe not the most lucrative possible investment out there, given the fact that there's never been a year lower than 7.6% in the better part of the last 15 years, I would say that it seems to be a relatively safe fund. Right.
Yeah. No. Definitely. Yeah. It's interesting. So and the other thing too is that I didn't send you this chart, but if I looked at some numbers, or so if somebody's age 50 years old and they start with us, say, for $25,000, and for the next 15 years they invested an additional $10,000 per year, and using average return, I actually used 8.5% as an average over that time period of 15 years. In 15 years, they turn 65. They can then start to withdraw that money, don't contribute anymore, supplement their retirement by $60,000 a year, and that money will last 10 years to the age 75. So as they start to draw down on the funds.
So what was the initial starting point?
Age 50.
And the initial actual investment?
$25,000.
So $25,000, $10,000 per year, so that's $150,000.
Yeah. So total contribution, $165,000. I think it works out they'll have a total value of about $425,000. Then they can just start to withdraw as an option to supplement retirement.
Not bad,
right? So it's not bad, exactly. So
there definitely are some real use case scenarios, and I'm sure you've seen it from some of your investors over the course of the last number of years, 15 years now, that they've taken the opportunity to do something like this, right? That's right. Yeah, the power of the numbers, right? So, well, let's shift to the client-facing side of the business and the problem that private lending solves. We could have multiple episodes on this conversation. However, I do want to highlight right now, what are some of the, I don't know if use case scenarios are the best point or best question I should ask right now, but who's taking a private mortgage right now with Accepted Financial? What do they look like, and what are the problems that you're solving?
Oh, wow. It's a fairly wide gamut. Basically, people who can't qualify, who need money and he can't qualify through. I think of one situation where we did a loan recently where a fella he owns an acreage property, he wants to sell it, he needs some money to help his cash flow getting through the next year. So he has lots of equity in his property, so we lent him $75,000 to help him get through until he sells the property and pays us back. The other situation we see fairly often is, unfortunately, bad things happen to good people and they get themselves into a financial situation. So that might be quite often we see a health issue. Someone may have a health issue that they were preventing them from working for an extended period of time. They're back now on their feet again, but through that period, they racked up their credit card, maybe started to not make payments on certain debts and obligations, and so their credit rating suffered, so they can't qualify, but they're back now. So I call it, sometimes people need, take one step backwards to go 3 steps forward. So we come in, provide them the financing, pay off all their consumer credit, etc. So now their credit rating will increase in time, and, usually typically 12 months or so. And then they can go back to the bank and requalify with a bank or another lender, an A lender, and pay us off.
How often do you find that out of these types of situations where people are stuck in debts and pay that off, like how frequently are they able to exit and move on? Well,
in our case, like this past year, our turnover was typically around 50-60% of our mortgages turnover every year.
Okay.
So, but this past year it's dropped down like 35%. And that's basically because the high interest rate environment we're in right now, it's difficult for people to refinance at these higher interest rates.
And does that have you concerned about the future of the money and where these people are going to be able to be paying out their mortgages? Or?
Yeah, it's definitely a concern, because at some point, whenever we lend money into a deal, we always ask the question, how do we get our money back? So we turn away a lot of deals where we're just not confident that the people are in a position that they'll be able to pay us back. Right?
Got it.
So
that's an important consideration, because everyone thinks that just anyone and everyone can get the money.
That's right.
Which is obviously not the case. I mean, and maybe they will through an individual investor or another bank or something of that nature, but you guys are obviously judging this. And Brad, if I had to ask you the question, how many applications do you see a year for lending?
A year? Well, it sort of depends on how much money we have available. The last year or so, we haven't had a lot of funds available, so we're not out promoting to the broker community that we have funds and to lend. But we'd fund typically, I think, about 40 some mortgages a year.
Okay.
So out of that, we probably would see 100 applications, maybe 100, maybe upwards to 150.
Okay.
It hard depends, Another way of looking at it, if for every 10 applications we receive, we probably issue commitment letters on 4 of them.
Okay.
So 6 of them we turn down.
Okay.
Just not our thing. Or not necessarily a commitment letter, but an expression of interest, right?
Yeah.
That we'd be interested in lending on it. And then out of that, we might fund 1 or 2, typically.
No, those are really, really key numbers to think about.
Yeah.
I want to ask you a few questions going back to that money conversation, if you don't mind.
Sure.
And I'm because initially, now that you've put some thought into it and you've thought about how people are getting the money, where you picked up your theories and ideas, investments, and so forth. What I'd be curious to know, especially as someone who's been in the industry for the better part of what appears to be 30 plus years now, is, and this is a good thing, it's a badge of honor, my friends, badge of honor, is you've had the opportunity as well to listen and talk and hear people from a different perspective and a different side. What I would love to know is, how do you think the attitudes that people place towards money and debt has evolved in the past number of years? If you could, and in your own words, in your own answer, like what have you noticed in the past, well, I guess since you started your career?
Well, I think it's a lot. People aren't afraid of debt as much as they were, I think, when I first started my career. Before, it was like there was more of a consensus out there, don't borrow money. If you need to buy something, you save the money until you can afford to pay cash for it. Today, it's more like, no, let's just borrow now, get what we need now, and we'll pay for it later, right? That's a big change.
Any thoughts on why that could be the case, or why you think that might be the case?
Well, I think it's a lot of it's a business, the industry, the financial industry driving it, right? Like, hey, it's easy to borrow money. Like now, it's funny, looking at car sales, for example. Financing car sales are now down to a weekly payment. They used to advertise, well, here's the monthly payment, $1,000 down, here's your monthly payment. And then they said, $1,000 down, here's your bi-weekly payment. Now they're saying, here's $1,000 down, here's your weekly payment. So imagine one day they're going to come, here's how much it costs you per day, right? So I think that's a lot of it, just to drive business, right? In high-ticket items. There's a financing component.
You're no longer buying a vehicle, you're buying a monthly payment, a weekly payment, or a bi-weekly payment. You're no longer buying a house, you're buying a payment. That's
right.
The attitude.
Like my parents' generation, there are a lot of this, like, if you want to buy a car, you save the money and you pay cash. But the other thing too is prices have gotten so high that, as like even to an average property, condo, entry-level condo, in the lower mainland, just to save the down payment is a real challenge, right?
Brad, if I gave you $200,000 to invest today, and I said your time horizon is 5 years, what are you doing with that money?
Diversify.
Sorry?
I'm going to diversify.
Okay.
So I'm not going to put it all in one thing.
Okay.
Even though I'm in the business, private lending business, and I certainly have a good holding in our company, but I still look at other options.
Okay.
But going back to my theory of, I like real estate, I understand real estate, there's different ways I can deploy that money. I would put it into a mortgage investment corporation. If I couldn't use that money to purchase a piece of real estate, I would look at buying into real estate investment trusts, REITs, which are fairly common, because it's just like the same concept as in our MIC, it's investors who are pooling all their money, and you're owning a little share in this shopping center in Ontario, and that apartment building in Calgary, and this piece of property in Vancouver. So that's where I would be leaning towards right now.
Hey, your answer is the best answer. Appreciate it very much, man. Thanks for coming on and bringing your knowledge
Awesome.
today.
All right, thank you.
Very appreciate it.
That was an unreal episode of The Flow. I hope you enjoyed it as much as I did on my side right here. If you haven't already done so, make sure to check out all of the incredible resources that we have available. You can find us on Instagram at Flow Mortgage Co. You can find us on our website, getflowmortgage.ca. And of course, don't forget our free first-time homebuyer masterclass that's currently available on our website for anyone who listens to the episodes. And if you loved what you listened here today, the only thing that we ask for is to share this with someone else that you think this could help. And hey, maybe leave us a great review online.